Okay, guys, so welcome to this video where we're going to look at buying gold if a US stimulus package is agreed by Congress, which should happen in hopefully December before Joe Biden goes into office in early January. And we've seen why this has been playing out in terms of a bullish gold price, not just this year in 2020. We've seen gold price go up from the lows of the year, currently at around 28% advance in the price of gold. It was at a high of 42% earlier in the year, but we have had a pullback since then. Now, what is the fundamentals driving gold higher? We have to look at what's been happening since 2007, since the financial crash. Gold has been extremely strong, going from a price of $534 or $38 an ounce up to $1,860 an ounce. Now, why is this the case? Why is Goldman Sachs, JP Morgan, all the investment banks pricing gold to rise to around 221, so $2,100 an ounce? Why are the investment market looking at gold prices to continue to rise? Well, we have to understand that gold is used as a hedge against inflation when you can no longer buy government bonds to protect yourself from the risk of inflation in a market. So just remember, the US dollar is the world's reserve currency. So when investors are heavily invested in US dollars, so let's say they've bought a lot of properties in dollars, or let's say they bought a lot of assets in dollars, like stocks, for an example, or art, for an example, or you're sitting with, say, 100 million in cash in the bank. Remember, inflation erodes the purchasing power of your money on a yearly basis. And if inflation is running at 2% per year, then you have to buy something that goes up in value by more than 2% to protect yourself against that inflation, so your wealth is protected. So the value of your dollars keeps its purchasing power and is not chipped away at 2% per year. So what investors buy? They buy 10-year government Treasury bonds, and that is just a bond that the government issues to borrow debt because they obviously run a deficit in their tax revenue. So let's say the US government has to spend, for an example, let's just say $5 trillion per year to run the economy, but they only take in $4 trillion in tax revenue, then they're short $1 trillion. So they issue bonds, and it basically says, if anyone buys this bond, I will promise to repay this bond to you in 10 years' time, plus a specific amount of interest per year. Now, the interest per year is the most important point, because remember, if inflation is running at 2% per year, then investors want to make sure that the interest paid on the Treasury bond is more than 2% per year. So the dollars that they're buying the bond with, they keep their purchasing power, they keep its value. So every year, the US government will issue that interest. So let's say in 1990, the interest was 8%. If inflation is running at 2%, so let's take 2% off at 8%, then you get a final interest of 6%. So clearly you're making 6% interest over inflation on that Treasury bond in 1990 when the government was paying 8%. So there's no risk of you losing your money. You're actually making 6% more than the rate of inflation. So your dollars are increasing its value by 6% over the rate of inflation. Investors are happy. There's no risk of them losing the purchasing power of their dollars. But when we look at this chart here, which shows the 10-year government bond, U.S. government bond from 2008 to 2020, you could see on the left-hand side, we have the interest rate over the rate of inflation. So what we have here, so if you can see from January 2008, if I scroll down and I'll show you how this works. In January 2008, the interest rate was 3.79% minus the inflation rate of 2%. Then we have a final interest over inflation of 1.79%. So back in 2008, investors were receiving more money from the interest rate the government bond was paying over the rate of inflation, so their wealth was protected. But obviously in 2008, we had that massive financial crash and interest rates were slashed to zero to make sure that people could borrow money from the banks very cheaply, and that could drive economic growth, help the economy recover, help employment pick up, and help the country recover from the financial crash in 2008. So obviously interest rates were slashed aggressively during that period. And what that meant is that investors were no longer being protected over that 2% inflation. So you could see, remember, this is the interest rate paid on the government bond over inflation of 2%. But you could see by the year 2012, investors were no longer receiving any interest over the rate of inflation. It was actually losing money over an annual 12-month period. Their dollars was decreasing by 0.5%. And you could see when your US dollars cannot be protected by government bond interest rates. You can't buy bonds to protect the value of your dollars. What do? Investors buy gold. And that's why the gold price shot up from 2008 all the way from around $800 an ounce up to $1,008 an ounce, pretty close to the price you are at now. So you can clearly see the correlation between negative interest rates going lower, bond prices shooting higher during that same period of time. And that's why we saw, if we go to a monthly chart, we can see from 2007 and to 2008, you could see up until 2012, as you can see, this is why gold was rising aggressively in the markets. Investors were buying gold to protect the value of their wealth from that 2% inflation. So if gold goes up over that period by 234%, then you have more than protected your wealth. You've actually increased your wealth dramatically, because inflation over 2008, 2012 overall would only have gone up 2, 4, 6, 8%, but you've made 236%. So take away that 8%, you're now sitting on 228% profit on the money that you've put into gold. So clearly investors were buying gold as a hedge, which was good. And then interest rates started to rise from 2012 up until 2013. And that's why the price of gold then started to dip lower. So you can clearly see here from 2012 to 2013, the gold price declined. And that is no surprise, in that it declined whilst the bond yield was rising. So interest rates were rising. Investors could then protect the value of their wealth by buying bonds. So they bought bonds. Remember, bonds is a very safe investment. Gold is speculative. It can rise and fall in value. So your wealth can go up and down quite dramatically. But remember, when you buy a 10-year Treasury bond, you're guaranteed to get your principal of money back, and you're guaranteed to get a certain amount of interest from the U.S. government. So it's more safe to buy bonds than it is to buy gold. Obviously, you can make more profit on gold, but obviously there is the risk that the price can drop. Then we saw again the bond yield kind of range between this period here. But then again, in 2018, interest rates in the United States started to go lower. And then again, gold then started to shoot up higher as a hedge against inflation. So up until 2018, investors, the wealth of their money was being protected by government bonds. So as you can clearly see here from 2016, the bond yield was above the level of 0% interest. So you were receiving some interest, so your dollars were not losing its value. And then in 2018, interest rates on 10-year bond yields started to go lower. And then that's when gold prices started to pick up aggressively. And that's why you look at gold from 2018, you can see the bullish trend really picked up, because the bond yield on 10-year government Treasury bonds was going lower, the interest rate was going lower, and investors again had to protect their wealth from inflation, and that's why gold shot up quite aggressively in the market during that period of time. So clearly we can see there is a very, very, very strong correlation between gold prices going higher and 10-year government bond yields. And yield is just the interest. Sorry, I didn't explain. A yield is literally interest. It's the same definition. It's just a word that the investment community use. So sorry if you got confused about that. But the 10-year government yield, meaning interest, was going lower. Now at the moment, investors are now losing 1.25%. So 1.25% interest. The value of their money is decreasing by 1.25% per year, because the interest rate on the government's 10-year bond is not protecting them. Is not paying them over 2% interest, and they're actually losing money. This is why gold is up so dramatically. Now, think about this fiscal stimulus package that's expected to come through by the Biden administration. They want to pump $2.6 trillion into the U.S. economy to help the economy recover from the coronavirus pandemic in early 2020. So what do you think is going to happen to gold prices? Well, we've seen what's happened since 2007. It's been going higher. We've seen what's been happening since 2008. Since 2018, it's been dramatically rising. And with 10-year government bonds at the moment not protecting the government, not protecting investors' wealth, governments have to keep interest rates low to make sure that governments can borrow their money cheaply. And remember, the Federal Reserve has said there's going to be no interest rate hikes for at least 3 years. So for 3 years, investors cannot buy government bonds to protect their wealth against the value of inflation. With $2.5 trillion coming into the US economy, that is a huge amount of inflation that could occur with that much money coming into the economy. So they have to protect their wealth against that inflation. So what are they doing? They're buying stocks and they're buying gold. So gold's had a pullback recently, which is no surprise. Nothing goes up in straight lines. You always get pullbacks within a larger trend. You've had it here in 2020. You've had it on multiple occasions. You get pullbacks within a trend. But again, this is why Goldman Sachs, this is why Morgan Stanley, this is why all the big investment banks and hedge funds are long gold, because they know investors have two choices to protect the value of their dollars from inflation. You buy gold or you buy stocks. You can't buy bonds. You can't buy government corporate debt, because a corporate debt's not paying enough interest. And if you do want to buy corporate debt, you're going to have to buy risky corporate debt that's going to pay a higher interest rate. And that's the reason they're paying higher interest, because they're a risky investment, and investors would rather take this kind of risk because it's a calculated risk. So what could we see to get into this trend and try to buy gold? We right now have a downward facing channel where we're making lower lows, as you can clearly see here, and lower highs. If we get a break above this channel, so if we can come outside of this channel, that will be the time to jump in and buy gold and anticipate that gold will rise, as it has been, based on this understanding of 10-year government bonds and inflation. So on a 1 month basis, this fluctuates by around 7%. So once we break out of the trend, we want to enter the market and have a stop loss that's around 7%. So around here, you can clearly see the pullbacks in price. You could say around 7%. So it really does work when you use this ATR volatility analysis. So we can get in the markets, have a stop loss of around 7%, get in, hold this trend, understanding that until interest rates in the United States start to rise, which the Federal Reserve has said is not going to incur until inflation overshoots their 2% target. And that's going to take some time, because you've got massive amounts of unemployment in the U.S. economy right now. So people are not working. There's a less demand for goods and services. Prices rise when there's a high demand. And until the unemployment rate goes down, people start to spend. More people are in work. The demand for goods and services rises. Wages start to rise because corporations start to compete with each other to get the best talent available in the labor market. And then they start to raise wages as their way of getting the best talent. And the rising wages goes hands in hand with lower unemployment and higher inflation. So until unemployment comes down in the US, which is going to take time, interest rates remain low to try to generate more borrowing at cheap rates of interest to drive up the demand for goods and services, drive up employment, drive up inflation, and hopefully get the US economy growing again. So that's the fundamentals behind this trade idea. It's a really good trade. Definitely get in once we break above this trend. And it's probably going to be once we have the news come out, they've agreed on a fiscal stimulus package. They're going to put the money into the US economy from January once Joe Biden's in power. And then we get in, then we buy, and we could ride this trend. And just remember, this is not a short-term trend. This has been happening since 2017. When bond yields are going negative, gold is rising. Remember, when bond yields went higher, gold went down. And at the moment, bond yields are negative again, so gold's going higher. And we've got 3 years of low interest rates. So for the next 3 years, you could highly expect another long-term trend like this, as we've seen already in the market. So I hope that makes sense. That's our setup for gold. Let's hope it plays out nicely and we can get in the market and make some money. Thank you.